And a very good morning to you. Thanks for spending part of your Sunday morning with us. There was enough significant news from Singapore to the Federal Reserve and Wall Street to make the head spin this past week. Of course, President Donald J. Trump's historic talks with North Korean leader Kim Jong-un brought some promise, but also many questions about the future of peace and denuclearization in the Korean Peninsula. And we learned that the Federal Reserve is going to make it harder to borrow money. The Federal Communications Commission also decided to roll back the Obama administration-backed net neutrality rules affecting access and cost of internet accessibility. And if that wasn't enough, a federal judge in Washington approved a huge merger between two mega media companies, Time Warner and AT&T. So what's the impact of all of this on investors large and small? Well, for the answers, we welcome back Rick Applegate to the Sunday Business Page. Not only is he a contributor to the Money Talk segment of News Radio 1020, KDK's Morning News, he's also a certified financial planner and senior financial advisor at R. Applegate & Associates, now associated with DB Root & Company. Rick, it's always great to have you on the show.
A pleasure.
And we learn a lot every time you're here. And boy, is there a lot to cover in the news of this past week. Let's start with President Trump's visit to Singapore and his meeting with the North Korean leader, Kim Jong-un. There is so much up in the air about this, and all sides, was the president snookered by the Korean dictator, or is he laying the groundwork for some fantastic denuclearization of the peninsula? And what, if anything, does this have to do with the stock market? What can you tell us about that?
Well, let's start with the stock market, which is the fact that such global issues always produce uncertainty, and any reduction in uncertainty is good for the stock market. So the president's efforts, at least in meeting with the dictator of North Korea to allay some of those threats of nuclear disaster between us, is a good move. And I think it helps the stock market in that regard. But there's a lot yet to flesh out.
Yeah, there is. And of course, the market reacts to all kinds of different things, and there was a lot to react to this past week. But I've always felt the market is a bit irrational. And you can disagree with me if you want, but it seems to me that these big news stories, like any foreign news, for example, last week, we didn't mention it when I introduced this, but the whole G7 in Canada, did that have any impact on the market?
I actually think, John, that's a more relevant headline than what happened in North Korea. It was kind of, quickly bypassed, and we got to North Korea, and wait a minute, what was that about G7? I think that's particularly relevant because we're talking about our closest trade partners having been snuffed in terms of, the relationship that appeared between the Prime Minister of Canada and our president. I think those are very important issues that we have to drill on in terms of these trade tariffs that have been rambling around. So that is more of a relevant issue on the tariffs to European Union, Mexico, and Canada than what's going on in North Korea.
Well, and that makes perfect sense because the whole tariff issue has an impact on jobs and the ability to export and import in the United States. And I think most Americans, certainly those from the Pittsburgh area, understand the notion of unfair trade.
Yes.
Because we have been victimized by unfair trade in the steel industry for so many years.
That's true.
And the notion that somehow or other foreign countries get to impose tariffs on us, and that's okay. But if we impose a tariff on them, then they yell and scream, and somehow or other we're the unfair guys.
Well, I think it's always about the manner in which the discussions are held. What we don't want to see for the best interests of Wall Street and for investors is a trade war. Now, we haven't had a trade war, a true defined trade war since the Depression. And we don't want another trade war. We want to talk about trade tariffs, and we want to talk about free trade between the countries, but I certainly don't want to see it escalate into a trade war.
Did the market react to that, or did we move on to so many other issues that it didn't make a difference?
It's funny. It really kind of put down the issue of the G7 and quickly moved on, believing that maybe there really isn't that much about this. But again, too, I think they kind of deferred until they get more information about what's really behind. And even as we're sitting here Sunday morning, happy Father's Day,
Thank you.
that in fact, I think, the president's talks about what to do with China, which occurred this past Thursday. It's going to be interesting to see how they filter through the market, you know. So we have a lot yet on the trade tariff issue.
Well, let's move on to the Federal Reserve, because I think a lot of people's eyes will glaze over when I say interest rates and the Fed rate and all that. But the Federal Reserve raised the rate 0.25%, the interest rates. Tell us what that means really for us as investors or just private citizens.
Well, the bottom line is that this was well telegraphed for a long time. It was not a surprise whatsoever that they were going to move at this June meeting to raise the rates 0.25 point. And in fact are going to continue to raise those rates to get back to what they think to be a more historical normalized rate.
Which is what?
Well, the normalized rate would probably be in the range of 3.25 approximately.
And what are we near 2?
We're at 1.75 to 2 now that they made this recent adjustment. So we have ahead of us, what was surprising in the Federal Reserve discussion is the fact that we may get 4 increases this year in total, not the 3 that had been talked about. So the dot plot, as they call it, which is the projection of where the federal funds rates are going to go, went from 3.31 to 4.31.
So for all of us as consumers and borrowers, whether it's our home mortgages or our credit cards, does that mean we're going to end up paying more in interest rates?
Yes, and so the best advice to the listeners out there is to try to spend down quickly the variable debt that you carry. That is the floating rates on your home equity lines or those credit cards, they're going to be going up.
Right. Normally mortgages, home mortgages are on a fixed rate.
That's right.
So you won't have to worry as much about that. But certainly credit cards, I mean, they
can fluctuate as at will, and they're going to be going up. On the other side, too, we have to keep in mind that the rise of interest rates ultimately is better for the older fixed income investors out there, because what we will see is a movement in the short-term crediting rates in the banks and the deposits. Now, they're usually not as quick to do that as they are to raise the borrowing costs.
So those who have bonds, for example, will get more of a return?
On the new issues, that is correct. So the issue for the rise of interest rates to the best interest of investors is, number one, stay shorter to intermediate on the durations of your bonds. Don't buy long yet. Wait for those interest rates to go up, then lock it in.
Good. Always good advice from Rick Applegate. We're not done yet. We're going to be back with Rick in just a few minutes to talk about the AT&T Time Warner merger. What's that all about? And net neutrality, the loss of net neutrality. Does that mean that we're going to be paying a whole lot more for what we see on our devices and on our television screens? We'll be talking about that coming up. Stick with us.